Ever read a headline announcing, a massive corporate merger or an acquisition and find yourself wondering, is there a way to actually make money from this before the deal officially closes?
Yeah.
It sounds, well, deceptively simple on the surface, just buy the shares of the company being acquired, right?
Mm-hmm.
But our sources reveal this is a strategy far more sophisticated, demanding, and ultimately favored by some of the most legendary investors because of its unique risk profile.
That's exactly right. This isn't about, betting casually on a headline. It's a precise analytical approach focused on the probability that an announced transaction will successfully navigate all its hurdles and close as planned.
Yeah.
It requires dissecting intricate legal agreements, understanding complex regulatory landscapes, and frankly, mastering quantitative analysis.
Yeah.
Definitely stepping into the specialized world of merger arbitrage here.
And that's exactly where we're taking you today. This deep dive pulls together insights from, well, a range of sources. A detailed practitioner's guide that really breaks down the mechanics, some fascinating case studies showing how real trades played out, expert analysis of the current market conditions impacting deal-making, and even insights from investment communities discussing the practical nuances.
Our mission today is pretty clear. To take you through this advanced strategy, really from the ground up, we want to explore precisely how it functions, the intensive, document-driven analysis that underpins it,
Right.
the specific risks involved that can make or break a trade, the potential returns it offers, and perhaps most importantly, why it is fundamentally considered a risk-managed approach by its most successful practitioners. We'll be drawing directly from the wisdom in these materials.
So for you, whether you're maybe preparing for a high-stakes meeting where M&A is on the agenda, or perhaps aiming to deepen your understanding of alternative investment strategies, or maybe you're just inherently curious about how sophisticated investors operate, well, consider this your intensive shortcut.
Get ready.
Get ready, because we're about to unpack the mechanics, the philosophy, and the reality of merger arbitrage.
Okay, so at its most fundamental level, merger arbitrage, or risk arbitrage as it's often called, is an investment strategy really designed to capture the spread.
A spread.
Yeah, the spread. This is the difference between the price a target company's shares are trading at in the open market after a merger or acquisition deal is publicly announced, and the final price the acquiring company has offered to pay for those shares upon the deal's successful completion.
Okay, so let's maybe visualize this. Say Company A announces it will buy Company T for, $60 per share.
Yeah.
Before the announcement, maybe Company T was trading at $45.
Yeah.
The moment the news hits, Company T's stock price jumps, but it might only go up to, say, $58. That $2 difference, the gap between the current market price and the offer price, that's the spread you're talking about, isn't it?
Precisely. That's exactly it. The market price doesn't immediately jump all the way to the offer price because, well, even with a definitive agreement signed and everything, there's always some risk the deal might not close for various reasons we'll get into.
Yeah.
The ARB buys shares of the target company, Company T in your example, at $58, with the expectation that if the deal successfully closes at $60, the target stock price will converge with that offer price, allowing them to capture that $2 difference. That's the basic idea.
So the most basic mechanic is simply buying the target company's stock. But our sources make it pretty clear this isn't always the case, especially in deals where the acquiring company is paying with its own stock rather than, straightforward cash.
Yeah, that's a crucial distinction, and it definitely introduces more complexity. If Company A is offering, let's say, 1.5 shares of its own stock, Company A's stock, for every share of Company T.
Yeah.
Well, the value of that offer is constantly changing based on Company A's own stock price, right? If Company A's stock goes down, the value of the offer for Company T's shareholders actually decreases. If it goes up, the offer value increases.
It floats.
Exactly. So to lock in the value of the offer as it stands when the trade is made, the arbitrager doesn't just buy the target stock, T, they also simultaneously short sell shares of the acquiring company, A.
Okay. So in a stock-for-stock deal, you're effectively betting that the relative value, that ratio of A shares to T shares, specified in the deal, will hold true upon closing, regardless of where Company A's stock price actually moves in the meantime.
Exactly right. You are long the target and short the acquirer. The goal is to profit from the spread between the target's current price and the value of the consideration offered, which, as we said, is dynamic in a stock deal converging as the deal approaches and successfully completes.
I see.
When the deal finally closes, you receive the acquirer's shares for your target shares. You use those shares to cover your short position in the acquirer, and the profit comes from that initial difference, that spread you locked in. It requires a high degree of precision and simultaneous execution, which we'll definitely talk more about later.
Yeah, it's clear this isn't just about hitting buy on a stock ticker.
Yeah.
And our sources really emphasize that this is a strategy deeply embedded in the history of sophisticated finance, favored by institutions and investors who really live and breathe risk management.
Well, that brings us beautifully to the historical context and I think the core philosophy behind it. This is a strategy with deep roots, and it was notably practiced by none other than Warren Buffett, especially early in his career.
Really? Buffett?
Yeah, he used merger arbitrage in the Buffett partnership, which he started way back in 1956, after his time learning under Benjamin Graham.
Warren Buffett, the legendary value investor known for buying whole businesses for the long haul, he was also doing arbitrage. That feels a bit counterintuitive at first glance.
It does, doesn't it? But his reasoning, as he explained it in his famous letters, actually reveals why it fit his broader philosophy. In the 1988 Berkshire Hathaway letter, for example, he explained that their insurance subsidiaries would sometimes engage in arbitrage when they found themselves with more cash than good ideas, as he put it.
Okay.
For those long-term commitments he's famous for. At such times, he noted, arbitrage sometimes promises much greater returns than treasury bills, provided you know what you are doing. The emphasis is mine there.
Provided you know what you're doing.
Mm.
So as a way to keep capital working productively and, importantly, safely, when there weren't necessarily attractive long-term investments available. A kind of sophisticated alternative to just holding cash.
Precisely. And this connects directly to his bedrock investment principles. You know Buffett's two famous rules. Rule number 1, never lose money. Rule number 2, never forget rule number 1.
Can't forget those.
Right. And while no investment is truly risk-free, merger arbitrage, when executed with deep analysis, is perceived as having a fundamentally different risk profile than traditional stock picking. Its outcome is tied to a specific, finite corporate event, the deal closing.
Right.
Not the indefinite future performance of a business or the, unpredictable direction of the broader market. The primary risk is the deal breaking, not the business itself deteriorating over many years.
So it's really a strategy focused on event risk and deal mechanics, rather than, say, business fundamental risk or overall market risk.
Exactly. And this focus on avoiding loss, on managing downside risk, is a really recurring theme among successful practitioners. John Paulson, who famously made his name with event-driven strategies, including merger arbitrage, put it quite starkly. He said, risk arbitrage is not about making money, it's about not losing money. You can minimize the downside, you get to keep all your earnings, and that helps performance.
Not losing money as the primary goal.
Yeah.
That really resonates with that classic Wall Street adage, doesn't it? There are old traders and there are bold traders, but there are very few old, bold traders.
Yeah, absolutely. This strategy is fundamentally about survival, about consistency, and compounding returns over time by diligently avoiding significant permanent capital impairment. It's not built on swinging for the fences with risky, low-probability bets. Charlie Munger, Buffett's longtime partner, offered his own take that fits perfectly here. He noted, it is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent.
Consistently not stupid. I like that.
Yeah. Merger arbitrage, viewed in this light, is about being consistently not stupid by meticulously analyzing every single potential pitfall in a deal and just avoiding those with unacceptable or unmanageable risks.
Okay, the philosophy is compelling, manage risk, avoid being stupid, survive. But how do you actually translate that into action? What's the detailed process an arbitrager follows from the moment a deal hits the news?
Well, the sources really emphasize that this strategy is incredibly research-intensive. It starts with the public announcement, yes, but that's really just the signal to begin the deep dive into all the documentation. The initial step is the meticulous analysis of all publicly filed information related to the transaction.
Okay, what specific documents are we talking about first?
It begins with the press release announcing the deal.
Right.
Now, while it's high level, it contains critical foundational information. You'll find, the names of the target and acquirer companies, the fundamental nature of the deal. Is it friendly or hostile? That's a big one.
Right.
Then the type of consideration being offered. Is it all cash, stock, a combination? Or maybe something less common like a special dividend or shares in a spinoff. And of course, the stated value of that consideration per target share.
Okay. The who, what, and how much at a basic level.
Yeah.
Pretty standard stuff.
Right. But you also need to look closely for the transaction structure. Is it a standard merger, a tender offer, a plan of arrangement, which is common in some jurisdictions, an asset purchase? And very importantly, is this a definitive agreement that's actually been signed, or is it just a preliminary, non-binding letter of intent, an LOI, or a memorandum of understanding, an MOU?
And why is that distinction so critical?
Because non-binding agreements fall apart at a much, much higher rate. You really need to know if the buyer is a strategic player, meaning they operate in the same industry, potentially looking for synergies, or if they're a financial buyer, like a private equity firm, often involved in leveraged buyouts or LBOs.
And the buyer type impacts the analysis. How exactly?
Well, a strategic buyer might face more intense antitrust scrutiny, especially if they're consolidating an already concentrated industry. Their motivation is usually operational synergies, cost savings, that sort of thing. A financial buyer, on the other hand, brings financing risk right to the forefront. Their deals are often much more sensitive to credit market conditions and broader economic cycles. The press release also typically mentions the premium offered over the target's unaffected price.
The price before the deal news.
Exactly, what the stock traded at before any rumors or news surfaced. It'll mention the total transaction size, the stated strategic rationale. Why is the acquirer actually doing this? Is it expected to be accretive to their earnings? What are the planned synergies? It'll give an expected timeline for closing, financing details if they're applicable, major conditions required for closing.
Wow.
The financial and legal advisors involved, sometimes knowing who the advisors are gives you clues. Whether there's a go-shop provision.
A go-shop, what's that?
That allows the target company to actively solicit competing bids for a limited period after signing the deal. It suggests maybe the initial price wasn't the absolute highest possible. You also check if the deal resulted from a formal review of strategic alternatives by the target board, and if any large shareholders have already agreed to support the deal by locking up their shares and committing to vote in favor.
That's an incredible amount of crucial detail. Just from the initial announcement. It's not just a headline at all.
Not at all, and it's just the starting point. This information is often supplemented pretty quickly by an 8K file-in with the SEC, which contains exhibits related to the deal, like the merger agreement itself sometimes. Then there are transcripts of conference calls where management discusses the transaction with analysts and investors, and formal investor presentations laying out the deal logic.
So you're gathering all these pieces.
Right. Arbitrageurs use this initial flood of information to build a detailed profile of the deal, assess the initial apparent risks, and begin constructing valuation metrics like comparing the target's implied deal valuation to that of comparable companies and past transactions. This helps gauge if the offer price seems full, fair, or maybe even low enough to potentially attract a competing bid, what we call an interloper.
An interloper. Okay, so you've digested everything from the announcement and these related materials. What's the next key document you absolutely have to scrutinize?
That would be the merger agreement itself. This is the legally binding contract that outlines all the terms and conditions in, frankly, exhaustive detail. It provides far more nuance than the press release ever could. Crucially, it specifies the break fees.
Break fees,
Yeah.
like penalties.
Exactly. These are amounts of money one party might have to pay the other if the deal terminates under specific predefined circumstances. Understanding these fees, who pays whom under what conditions, is a key part of assessing the cost of failure for the parties involved and, sometimes, their commitment level.
So there's potentially compensation if the deal falls apart, depending on the reason why.
Precisely. The agreement also clearly states the termination date, sometimes called the outside date or drop-dead date. This is the absolute deadline by which the deal must close. If it doesn't close by then, either party can typically walk away unless the date gets formally extended. And, probably most importantly, it lists every single condition that must be satisfied for the deal to close. This is much more granular, much more detailed than the major conditions usually mentioned in the press release.
The full list of hurdles. Every single one. That sounds absolutely vital for risk assessment.
It is. It's critical. You're looking at things like all the necessary regulatory approvals, which specific agencies, in which countries, required shareholder votes, target shareholders, acquire shareholders, the absence of material adverse effects, or MAE clauses.
MAE clauses.
Yeah, these are conditions under which a significant negative event happening to the target or sometimes the acquirer could potentially allow the buyer to terminate the deal. They're often heavily negotiated. You also look for completion of financing, necessary third-party consents like from major customers or lenders, and so on.
And for cash deals, you mentioned financing earlier.
Yes, for cash deals, confirming the financing is committed not just based on best efforts or contingent on future market conditions is absolutely paramount. This commitment, or lack thereof, is detailed in the agreement itself or in related financing commitment letters filed alongside it.
Committed financing versus contingent financing feels like a massive risk differentiator, a huge difference.
It absolutely is. A deal relying on financing that isn't firmly locked in is inherently much, much riskier, especially if credit markets get volatile. Now, following the merger agreement analysis, often a proxy statement or sometimes an information circular is filed.
Okay, what's that for?
This document is required if the target company's shareholders need to formally vote on the merger or if the deal is structured as a tender offer, where the buyer directly asks shareholders to tender or sell their shares to them. The proxy statement is often incredibly rich in detail.
What kind of detail are we talking about here? More than the merger agreement.
Often, yes, especially regarding the process. It frequently includes a lengthy section detailing the background of the merger. This is usually a blow-by-blow account of how the negotiations actually unfolded, dates, meetings, offers, and counteroffers exchanged, and importantly, the target board's reasoning and analysis for recommending the deal to shareholders.
Like a history of the deal itself.
Exactly. It might also provide an updated, estimated timeline for completion and explain the specific process for shareholder votes, or, if applicable, electing the form of consideration if shareholders have a choice between, say, cash and stock. Reading that negotiation history can sometimes reveal subtle insights into potential sticking points, or maybe the likelihood of an interloper emerging if other parties were sniffing around earlier.
So it's not just about the final terms, but really understanding the entire journey of how the deal came to be.
Yeah.
That context matters.
Precisely. You're trying to build a complete 360-degree view of the transaction from all the official filings. Now, based on this really deep dive into all the documentation, the sources highlight the importance of assigning some kind of proprietary risk rating to each deal.
A risk rating system specifically for mergers. Kind of like credit ratings, but for deal certainty.
Yes, that's a very good analogy. Firms often use a system, the source mentioned one called Alpha Rank, for example, assigning ratings from, say, AA down to CCC, and also maybe an NR for not rated. AA would represent the highest quality deals.
Okay.
Minimal, clearly defined conditions, often involving a highly reputable cash buyer, signifying the highest perceived probability of closing.
The slam dunk deals, relatively speaking,
Yeah.
if such a thing exists.
Relatively, yes, you still do the work. Then maybe BBB represents investment-grade quality deals, still considered high probability. Historically, according to the sources, something like 50% of friendly announced deals fall into the BBB or higher category.
Okay, half are pretty solid.
Yeah, generally. But then as you move down the scale to BBB and CCC, the deals become increasingly speculative.
And what makes them riskier? What puts them in those lower categories?
Well, lower ratings indicate increasing potential issues or hurdles that were identified during that document analysis. These could be significant antitrust concerns, really complex financing arrangements, reliance on uncertain third-party approvals, maybe litigation risk or other red flags. These deals simply have a lower estimated probability of closing successfully.
And NR not rated.
Yeah, the NR category is often used for deals where something unusual is happening. Maybe the target stock is actually trading above the offer price, which suggests the market believes a higher offer is coming or some other outcome is likely. Or maybe it's trading way, way below the unaffected price, suggesting extreme skepticism about closing or perhaps some major unknown issues.
And this risk rating presumably directly influences how much capital you'd actually allocate to a particular deal in your portfolio.
Oh, absolutely. This is a critical risk management tool. Higher rated deals, your AAs, your BBBs, they typically receive larger allocations of capital from the arbitrage portfolio, reflecting the higher conviction in their closing probability.
Makes sense.
Lower rated deals, BB, B, CCC, they get much smaller allocations, or sometimes they're avoided entirely if the potential return just doesn't adequately compensate for the perceived level of risk, which, segues nicely into the fundamental question. Despite all this intense analysis, why do deals fail? This raises an important question. Based on the sources, what are the main reasons a deal can actually break? I think they identified 5 key ones.
Okay, the 5 pillars of deal failure risk. Let's hear them. What should you be most worried about?
Okay, first and often foremost these days, antitrust regulators. In the U.S., that's primarily the Federal Trade Commission, the FTC, or the Department of Justice, the DOJ. In Canada, it's the Competition Bureau. They can sue to block a deal if they determine it would substantially lessen competition in a relevant market, potentially harming consumers through, higher prices or reduced choice.
And we've certainly seen increased scrutiny from these regulators in recent years, haven't we? Feels like that's become a bigger hurdle.
We absolutely have. And assessing this risk requires a deep understanding of the specific markets involved, the market shares, the size of the combined entity, and, importantly, the current regulatory climate and enforcement priorities, which can shift.
Okay, antitrust is number 1. What's second?
Second, foreign investment regulators. In the U.S., the big one is the Committee on Foreign Investment in the United States, or CFIUS. They review deals involving non-domestic buyers for potential national security concerns. In Canada, it's Innovations, Science, and Economic Development Canada, or IZ. These reviews can be lengthy, often opaque, and regulators can impose conditions or ultimately just block the transaction entirely.
Another area that feels increasingly relevant in the current geopolitical climate, especially for cross-border deals.
Definitely. Very sensitive area. Third is financing failure. As we discussed earlier, if a deal is reliant on external financing, particularly debt, for a leveraged buyout and that financing isn't fully committed, or maybe the credit markets just deteriorate significantly before closing,
Right.
the buyer may simply be unable to secure the necessary funds. That causes the deal to collapse.
A risk that can fluctuate dramatically with macroeconomic conditions, interest rates, market sentiment.
Precisely. Highly cyclical sometimes. Fourth, shareholder vote failure. If the deal structure requires a vote by the target company's shareholders, or in some cases the acquirer shareholders, which we'll come back to, and they vote against it, well, the deal obviously cannot proceed.
Why would shareholders vote against getting a premium?
Well, they might feel the offer's too low, maybe they dislike the terms, maybe an activist investor rallies opposition, or, critically, it could be related to the fifth reason.
Which is, let's have number 5.
The fifth reason is basically the buyer gets cold feet, often trying to invoke that material adverse effect, MAE clause we mentioned. While it's harder to prove legally after a definitive agreement is signed, significant negative changes either in the target company's business, maybe the acquirer's own business, the specific industry they operate in, or just broader economic conditions can cause the buyer to look for an exit hatch.
So something major changes after the deal is signed.
Right. For example, a sudden, drastic plunge in commodity prices could make acquiring a mining company look far less attractive to the buyer than when the deal was first struck months earlier. This often leads to lawsuits and litigation, but the deal can still ultimately break. This risk really necessitates continuous monitoring of all factors affecting both companies and their operating environment right up until closing.
So those are the primary failure scenarios you're constantly analyzing probabilities for.
Okay, given that framework, are there certain situations that are just such bright red flags that an experienced arbitrager would just immediately pass on a potential opportunity, regardless of how juicy the potential spread looks? Is there like a risk mitigation checklist that leads to an automatic no?
Yes, absolutely. The sources definitely highlights several conditions that should probably lead to an immediate pass, even if the spread looks tempting on the surface. First, if the buyer lacks credibility.
Credibility.
Yeah. Have they maybe terminated previous definitive agreements without clear justification? Is there any doubt about their financial ability or even their willingness to actually close this deal? If the buyer themselves feels shaky or unreliable, you pass. Buyer history and reputation really matter.
Okay, buyer reputation is key. What else?
Fundamentally. Second, if the financing source is unclear or lacks credibility. If the source of funds for a big cash deal seems murky, overly complex, or just hard to verify, that's a major red flag. Pass.
Transparency matters. Definitely. Third, if the deal is not a definitive agreement, remember we talked about LOIs and MOUs, if it's just a letter of intent, a memorandum of understanding, or even just an announcement of exclusive negotiations, these preliminary agreements fall apart with extremely high frequency before even reaching a definitive stage. Avoid them. Similarly, be extremely cautious with hostile deals.
Hostile takeovers.
Yeah, they are inherently less predictable, they often involve lengthy and costly litigation, and they can introduce significant market beta or correlation to overall market movements, which arbitrage usually tries to avoid. Friendly negotiated transactions are generally preferred.
So waiting for that signed definitive agreement is absolutely non-negotiable for a serious ARB.
Absolutely. Rule number 1 for many. Fourth, if the regulatory risk appears excessively complex right from the start, or if the regulators express strong early opposition. Some antitrust reviews, for instance, are notoriously difficult to predict, sometimes described by practitioners as having near coin flip odds. The sources are pretty clear on this. Don't rely on luck for regulatory outcomes. If the path to approval looks like a minefield from the outset, just pass. Find an easier deal.
Avoid the coin flips where possible.
Yeah.
Okay. And is there one single factor that serves as an immediate, hard, no, like see this, walk away, don't even think about it?
Yes, there is one highlighted as particularly critical, and it's maybe not immediately obvious why it's such a deal breaker for risk mitigation. The situation where the deal requires a buy-side vote.
A buy-side vote. You mean the shareholders of the acquiring company have to vote to approve the merger? Why is that an automatic deal breaker? Isn't it usually about the target shareholders approving the offer they're receiving?
Well, what's fascinating here and really crucial to understand from a risk perspective is that requiring the acquirer's shareholders to vote on the transaction, which usually happens when the acquirer is issuing a substantial amount of new stock to fund the deal, potentially diluting their existing shareholders significantly.
Okay.
It effectively puts the acquiring company itself in play.
In play? You mean it could now become a target for another buyer? The acquirer could get acquired.
Precisely. By needing its own shareholder approval, the acquirer suddenly becomes vulnerable. A potential hostile interloper could emerge and make a premium offer to buy the acquirer.
Wow.
So if that happens, the acquirer's shareholders, who were just asked to vote on buying the original target company, now have this juicy alternative, getting a premium for their own shares from this new interloper. In that scenario, they are highly, highly incentivized to vote against the original deal with the target company.
Because that frees them up to take the better offer for themselves.
Exactly. Voting no on the first deal allows them to accept the interloper's higher offer for their own stock. This dynamic makes the original deal's chance of closing plummet to near zero almost instantly.
Wow. So the buyer needing approval exposes them to being bought themselves, which in turn kills their original acquisition attempt. That's a complex, kind of unexpected failure path.
It is, and according to the sources, it's generally a scenario to avoid entirely if you're focused on high probability trades. If you see a buy-side vote is required, the advice is typically pass immediately. Don't touch it.
Are there any exceptions to that rule mentions, or is it truly a hard line for arbitrageurs focused on minimizing downside risk?
The consensus from the sources really leans towards it being a very hard line. The risk of an interloper emerging in that specific situation is simply too unpredictable and too potentially catastrophic to the original deal's probability of closing. It adds a whole layer of complexity you just don't need.
Fascinating. Okay, so you've done the deep qualitative analysis, you've scrutinized all the documents, you've evaluated the major risks, and you've filtered out the immediate passes like the buy-side vote scenario. Now, how do you turn all this into a potential investment? How do you actually quantify the opportunity?
Right. This is where the quantitative analysis comes in. You need to calculate two key metrics, primarily: the merger yield and the implied odds of success. The merger yield is essentially the estimated annualized return you stand to make from capturing that spread we talked about.
Annualized return. Okay, so it specifically factors in how long you expect to have your capital tied up in the trade.
Yeah.
Time value of money.
Exactly. Time is a crucial component. You calculate the net spread first. That's the difference between the total merger consideration offered per share and the target's current market price. But importantly, it's adjusted for a few things.
Like what?
Like any expected dividends the target company might pay out before the deal closes, you get to keep those. You also subtract estimated trading commissions and, crucially, any costs associated with borrowing shares if you're shorting the acquirer in a stock deal. That short borrow cost can be significant sometimes.
Okay, so the net spread is the real potential profit per share. And there's a specific formula to annualize that.
Yes, the sources typically provide the formulas. First, the total merger consideration per share is the cash consideration, if any, plus the exchange ratio, if stock is involved, multiplied by the acquirer's current share price, plus any anticipated net dividends per share before closing.
Got it.
Then the net spread per share is simply that merger consideration minus the target's current share price, minus trading commissions per share, minus estimated short borrow cost per share, if applicable.
Okay, that's the net profit per share.
Right. Then, to get the annualized merger yield, the formula looks something like this. You take 1 plus net spread current share price and raise it to the power of 365 divided by the estimated number of days until completion, and then subtract 1.
Whoa, okay. So basically, a wider percentage spread and a shorter expected timeline for the deal to close both pump up that annualized yield figure.
Precisely. A $1 spread closing in 3 months gives a much higher annualized yield than the same $1 spread closing in 12 months. The core question this metric helps you answer is this potential annualized return attractive enough given the perceived risk level you assigned earlier? Does it exceed your required rate of return, your hurdle rate, or your cost of capital for this type of strategy?
Okay, that's yield. What about the implied odds of success? How do you calculate the probability the market is assigning?
Right. This metric tries to estimate the likelihood of the deal closing based purely on where the target stock is trading relative to the offer and where it might fall if the deal breaks. It sort of assumes the market price reflects a collective, rational assessment of the potential upside if the deal closes successfully versus the potential downside if it breaks.
And how do you estimate that downside?
To calculate the potential downside, you need to estimate the unaffected share price, basically. What the target stock would likely trade at on its own fundamentals if the deal news suddenly disappeared tomorrow. You estimate this based on the target's historical trading range, its fundamentals, comparable company valuations, sector trends, maybe analyst price targets from before the deal.
So the price before any deal noise influenced it.
Pretty much, yeah. It's an estimate, obviously. So the formulas look like this. Upside equals the total merger consideration minus the current share price. Downside equals the current share price minus your estimated unaffected share price.
Okay, upside is gain if it works, downside is loss if it breaks.
Right. Then the implied odds of success is calculated as the downside divided by the sum of the upside plus the downside.
Let me work through that. So if the potential loss from a broken deal, the downside is, say, twice as large as the potential profit from a closed deal, the upside, then the implied odds of success derived from the current market price would have to be higher than 66% for that price to make rational sense. Is that the logic?
That's exactly the logic. The market price for the target stock implicitly reflects the market's collective assessment of the closing probability. A lower price relative to the offer implies lower perceived odds of closing by the market, which results in a wider spread and potentially a higher yield, assuming it does close.
And vice versa.
Right. A higher price relative to the offer implies higher perceived odds by the market, leading to a narrower spread and a lower potential yield. Ideally, this implied odds figure calculated from the market price should correlate reasonably well with your own qualitative risk rating you assigned earlier.
So a deal you've rated AA should be trading at a price implying very high odds of success.
Exactly. While a CCC-rated deal would likely be trading at a price implying much lower odds, if there's a big disconnect like you rate it AA, but the market implies only 70% odds that might be an opportunity, assuming your analysis is correct.
So you're essentially checking if the market's pricing aligns with your own detailed risk assessment, and using both the potential yield and these implied odds to make the final investment decision.
Exactly. The quantitative analysis helps refine the decision based on all that qualitative assessment you did first. You're looking for situations where your detailed analysis suggests the actual closing probability is significantly higher than what the current market price implies, offering an attractive risk-adjusted yield. This combined analysis, the qualitative risk rating and the quantitative yield odds calculation, is what ultimately drives the capital allocation decisions.
And as we mentioned, riskier deals, those BB or lower ones, get smaller position sizes, reflecting both their lower implied odds from the market and your own assessment of their higher probability of failure.
Precisely. It's all about managing that risk profile.
Okay, so it's this really sophisticated blend of legal, regulatory, financial, and quantitative analysis. And risk management isn't just about picking the right deals, is it? It's also about how you manage your overall portfolio of these different arbitrage positions.
Absolutely. The sources really emphasize portfolio-level risk management. While any individual deal carries that break risk, looking at historical statistics provides some useful context. Roughly, maybe 6% of announced merger deals have failed historically. That's kind of the baseline downside risk pool you're dealing with across a portfolio.
6% fail rate. Okay.
But interestingly, the data also suggests that historically, around 6% of deals have also seen their consideration revised upward.
Upward. How?
Either because a competing bidder emerged, that interloper we talked about forcing a bidding war, or sometimes the original acquirer just voluntarily bumps their offer to ensure shareholder approval or fight off potential competition.
Ah. So these upside surprises from bidding wars or bumps can, over a long period and across a diversified portfolio, potentially offset some of the losses from the deals that inevitably break.
That's the potential portfolio effect, yes. Across a large number of deals over time, the gains from these positive surprises, these bumps, can provide some mitigation against the capital impairment from the deals that fail. It doesn't eliminate risk, but it can help the overall portfolio performance.
Interesting dynamic. Now, the strategy is also often implemented using leverage, right? Given its perceived lower risk profile relative to just betting on market direction.
Yes, leverage is commonly used, but it's a double-edged sword, obviously. It amplifies returns when deals close successfully, but it also significantly amplifies losses if deals break. So managing leverage is crucial.
How's that balanced? What's a typical level?
It varies, but the sources suggest that for a typical diversified arbitrage portfolio, a sort of sweet spot for gross exposure, which is the total value of your long positions plus the total absolute value of your short positions.
Okay, longs plus shorts.
Right. That gross exposure is often somewhere between 150% and 200% of the portfolio's equity. They provided an example reference portfolio with, say, 154% long exposure and 28% short exposure, resulting in 126% net long exposure but 182% gross exposure. The level of gross exposure fluctuates depending on the attractiveness and availability of opportunities, but staying within a discipline range is key to managing overall portfolio risk. Too much leverage increases vulnerability.
For diversification within that portfolio is paramount, I assume. You wouldn't put all your eggs in one merger basket.
Oh, essential. Absolutely essential. Diversification across different industry sectors is critical to avoid concentration risk, especially in industries prone to specific regulatory challenges like telecom or healthcare, or those highly sensitive to economic cycles like energy or materials, which can impact LBOs particularly hard.
Makes sense.
Diversifying by deal type, cash versus stock, friendly versus maybe more structured tender offers, and also by geography helps spread the risk further. The sources also often advise limiting overall exposure to leveraged buyouts, LBOs, because their success is particularly sensitive to the availability and cost of credit, making them more exposed to cyclical downturns in the economy or credit markets.
The goal being, as you mentioned earlier from Paulson, to live to fight another day. Avoid the fatal blow.
Exactly right. And that's where maximum position sizing comes in. No single deal, no matter how high its risk rating seems, even AA, should represent such a large percentage of the total portfolio that its unexpected failure could cause irreparable damage. Riskier deals, those BB rated or lower ones, are given significantly smaller allocations, sometimes just 1% or even less of the portfolio's capital, compared to potentially 5% or maybe even more for a very high conviction AA rated deal. This disciplined sizing is fundamental to surviving the inevitable broken deals that will happen over time.
Okay, so you've done the deep analysis, you selected the opportunities, you've sized the positions according to risk, you've considered diversification. Now, the rubber really meets the road, executing the trade itself. How do you actually put these positions on in the market?
Right, the execution mechanics. Typically, the investment vehicle is the target company's common shares, as that's usually what the merger offer applies to. However, sometimes opportunities can exist in other securities of the target company, like preferred shares or maybe even corporate bonds or listed options, if the terms and the spread offered there are attractive and perhaps offer better risk-adjusted returns compared to just trading the common stock. You analyze which specific security offers the best way to capture the spread.
So for a straightforward all-cash deal, it's relatively simple then.
Yeah.
Just buy the target stock.
Yes, for an all-cash deal, the mechanic is usually just buying the target shares on the open market at a price below the announced cash offer price. You figure out your entry price based on the yield and risk, you place your buy order, and wait for it to execute. The relative simplicity of cash deals is one reason they are often favored by ARBs and tend to receive higher risk ratings, assuming, of course, that the financing is solid and committed.
But for a stock consideration deal, where the buyer is paying with its own shares, the execution sounds significantly more complex, as you alluded to earlier.
It is significantly more complex, yes, and it requires much tighter control during execution. Because the value of the consideration is fluctuating with the acquirer's stock price, you need to hedge out that market exposure to the acquirer's stock. The standard way to do this, as we discussed, is by shorting the acquired shares at the exact same time or as close as possible to when you buy the target shares.
Right, the long target, short acquire pair.
Exactly. You are essentially creating a paired position designed to be largely neutral to the general market movements of the two individual stocks, but profitable if the spread between their relative values closes according to the deal terms.
But going short involves borrowing shares, right?
Mhm.
Is that always possible or easy to do, especially for a large position?
This is a critical point emphasized repeatedly in the sources. Before you even seriously consider putting on a stock deal arbitrage trade, you must verify and ideally secure the short borrow of the acquirer's shares. You need to confirm that the shares are available to borrow in sufficient quantity for your intended position size, and, very importantly, that the cost of borrowing them, the borrow fee or borrow rate, isn't prohibitive.
Why? How high can borrow fees get?
Oh, they can vary wildly. If a stock is hard to borrow because lots of people want to short it, the annual borrow fee can sometimes be extremely high, maybe even double-digit percentages annualized. A very high borrow fee can eat significantly into, or in some cases, even completely eliminate the potential profit from the merger spread itself.
Wow, okay, so check availability and cost first. And what happens if you can't secure the borrow? Or worse, if the borrow gets recalled unexpectedly before the deal closes?
Well, if you cannot secure the borrow up front at a reasonable cost, you simply pass on the deal. Doesn't matter how attractive the spread looks on paper. It's a non-starter. You can't execute the hedge.
Okay.
Now, the recall risk is the dangerous one. If the borrow is secured initially, but then gets recalled by the institution that lent you the shares before the deal closes, which can happen, lenders can recall shares. You are forced to buy those shares back on the open market immediately to return them.
Forced buying.
Yes. And if the acquirer's stock price has risen significantly since you initially shorted it, you're forced to buy high after you sold low, locking in a potentially significant loss on the short leg of your pair trade. In a volatile market, or worse, a stock experiencing a short squeeze where prices are rocketing up, a borrow recall can be absolutely disastrous for an arbitrage position. This is a major execution risk that must be actively managed.
That risk of a forced buy-in due to recall sounds genuinely terrifying for an ARB. How do professionals typically manage that risk during the execution phase?
Well, first, they often work with prime brokers who have large pools of stock available to lend and sophisticated systems for managing borrows. But assuming the borrow is confirmed and deemed reasonably stable and affordable, the sources strongly recommend using what's called a pair trader.
A pair trader, what's that?
It's essentially an automated trading system or specific order type offered by brokers. It's programmed to execute both legs of the trade, buying the target shares, and short selling the corresponding number of acquired shares based on the deal's exchange ratio simultaneously, or as close to simultaneously as humanly or electronically possible.
To minimize the price movement, the slippage between buying one stock and selling the other.
Exactly. The timing difference is called legging risk. If Company A is buying Company T for, say, 1.5 shares of A per share of T, you input a pair order to, for instance, buy 100 shares of T and simultaneously short 150 shares of A. The pair trader algorithm attempts to execute both sides instantly at prices that lock in your desired spread. This speed and simultaneity are absolutely imperative to capture the value of the spread accurately and avoid adverse price movements on one leg before the other side can be executed. It really requires sophisticated trading infrastructure and expertise.
Okay, so let's say you've done the exhaustive analysis, selected the deal, sized it appropriately, potentially secured that crucial short borrow, and executed the paired trade using a pair trader. Could you finally just sit back, relax, and wait for the closing date to roll around?
Not quite. Not if you want to manage risk properly. You've established the position, yes, and now you enter what you might call monitor mode. While the most intense upfront research is done, continuous vigilance is absolutely required right up until the moment the deal either closes or definitively breaks. This is far from a passive, set it and forget it strategy.
Okay, so what exactly are you monitoring during this period? What are you looking for?
Pretty much everything that could potentially impact the deal's probability of closing or its expected timeline. This includes closely following all news releases from both the target and the acquirer companies, things like quarterly earnings reports, any changes to guidance, other major corporate announcements. You're reading company and sector-specific media coverage constantly, looking for potential issues or developments.
Staying on top of the news flow.
Constantly. You're tracking regulatory activities very closely. Any statements from agencies like the FTC or DOJ, Court filings if there's litigation, hearing schedules, waiting periods expiring. You're monitoring the status of financing for cash deals or LBOs, making sure conditions are being met. And you're keeping an eye on general market conditions and sentiment, especially anything that could influence the acquirer's willingness or financial ability to actually close the deal.
So you're essentially looking for any signal, positive or negative, that could materially affect the deal's chances of success.
Precisely. A positive signal might be regulatory approval being granted faster than expected, or maybe a key large shareholder publicly announcing their support. A negative signal could be an unexpected regulatory hurdle suddenly appearing, a financing condition not being met by a deadline, or maybe a significant deterioration in one of the company's core businesses that might potentially trigger an MAE clause review. Being ready to react, which could mean potentially adding to the position if conviction increases, or reducing or even exiting the position entirely if the odds seem to worsen based on new information, is absolutely crucial.
And beyond just monitoring, there might still be required actions on your part as the holder of the target shares before closing.
Yes, depending on the specific deal structure. If it's a tender offer, you will need to formally tender your shares through your broker by a specified deadline in order to receive the merger consideration. If it's a merger or a plan of arrangement that requires a shareholder vote, you'll need to ensure your shares are voted in favor of the transaction, assuming, of course, your analysis still supports the deal closing.
Got to vote your shares.
Right. And if there's an election of consideration where shareholders might have a choice between receiving cash or stock, or a mix you need to make that election by the specified deadline, missing these procedural steps can actually prevent you from receiving the merger consideration on time, or at all in some cases.
Okay, so you monitor, you take necessary actions like tendering or voting, and then you just wait for all the conditions listed in that merger agreement to be officially cleared.
That's essentially the process. The clock is ticking towards that termination date we talked about, and you are waiting for each specified condition precedent in the merger agreement to be satisfied or waived. The most common major hurdles, as we discussed, are typically getting the required shareholder votes and securing all necessary regulatory approvals. Once all conditions are met and the deal officially closes on the agreed-upon closing date, that's when the arbitrager finally gets paid.
And how does the payment actually happen? What does that look like in your account?
Well, if it was an all-cash deal, it's pretty simple. The cash consideration per share is deposited directly into your brokerage account in exchange for your target shares, which disappear. If it was a stock-for-stock deal where you were long the target and short the acquirer,
Right, the pair trade.
the acquirer's shares you receive for your tendered target shares are automatically used by your broker to cover or flatten your short position in the acquirer's stock. Your profit then comes from the difference between the value received for your target shares in terms of the acquirer's stock value at closing and the cost basis of your long target position, less transaction costs, and those cumulative short borrow fees you paid along the way. That's successfully bringing home the bacon, capturing the spread.
And how long does this whole process take, typically?
Yeah.
From trade initiation to getting paid?
It can vary hugely. Deals can close relatively quickly. Straightforward tender offers with minimal regulatory hurdles can sometimes close in as little as, say, 45 days. But complex deals, especially those involving significant global regulatory reviews in multiple jurisdictions, or those facing legal challenges or litigation, can take much longer, sometimes a year, or even more in some cases.
Wow, a year or more. It truly sounds like a strategy that rewards patience, extreme attention to detail, and diligent, continuous monitoring. It seems completely different from trying to predict which tech stock will double next year, or trying to time market tops and bottoms.
That's exactly right. It's a focus on identifying perceived high-probability outcomes based on defined corporate events and legally binding contracts, rather than trying to predict future business success or broad market movements. Going back to Buffett and Munger, it's really about meticulous analysis to avoid losing money and consistently applying a disciplined process over and over again. The primary goal usually isn't maximizing the return on any single individual deal, but rather maximizing the probability of success across a diversified portfolio to generate consistent, relatively low volatility returns over time.
Okay, let's try to bring this to life even more with some real-world examples. Our sources mention several case studies. Instead of just listing them off, could we maybe delve into a few specific ones to see how the principles we've been discussing actually play out in practice?
Absolutely. I think case studies are invaluable for illustrating both the practical application and sometimes the unexpected challenges of merger arbitrage. Let's look at a few diverse examples that were mentioned in the source materials. How about we start with the Johnson Controls acquisition of Tyco International back in 2016? That was valued around $16.5 billion. This was presented very much as a strategic merger aimed at creating significant cost and revenue synergies, and it also included an advantageous corporate tax inversion element.
Okay, so the strategic rationale, the synergies and the tax benefits were key drivers for the buyer, gave them strong motivation to close.
Yes, those factors definitely underline the buyer's motivation to see the deal through. The arbitrage opportunity itself arose from the spread between Tyco's market price and the implied value of the Johnson Controls shares being offered in the stock-for-stock exchange.
What were the main risks the ARBs were analyzing there?
Well, the primary risks involve executing that stock-for-stock exchange, efficiently requiring that simultaneous long Tyco short Johnson Controls paired trade we talked about, and navigating any potential political or regulatory scrutiny related to the tax inversion aspects, which sometimes draw criticism. But ultimately, funds like Paulson & Co. and Glenview Capital Management reportedly traded this spread successfully, betting on the strategic value being realized and the deal closing relatively smoothly, which it did. Okay, another notable example, this one from the pharmaceutical sector, is Bristol Myers Squibb's acquisition of Celgene in 2019. That was a massive deal, valued at $74 billion.
Huge deal.
Huge. And it was clearly focused on acquiring Celgene's very strong drug pipeline, which was seen as strategically crucial for BMS's future growth prospects.
So again, a very clear strategic rationale driving the buyer. What was the arbitrage play and the main risk that created the spread there?
The opportunity was the pretty significant spread that opened up after the announcement. This reflected market concerns about, well, the sheer size of the deal, the potential complexity of integrating two massive pharma companies, and definite antitrust questions related to potential overlap in their combined drug portfolios.
So integration risk and regulatory risk were key.
Exactly. Arbitrageurs bought Celgene shares, betting that the strategic value of Celgene's pipeline was compelling enough for BMS to push hard to overcome these hurdles, and that regulators would ultimately approve the deal, perhaps requiring some divestitures of overlapping products. Funds like Elliott Management and Starboard Value were reportedly active and ultimately successful in this trade. It required strong conviction in the regulatory outcome and definitely patience through a lengthy review process. Now, for a deal that faced much more overt regulatory challenges right from the very beginning, let's look at the T-Mobile-Sprint merger. That was announced way back in 2018 and didn't actually close until 2020 after a lot of drama.
Right, I remember that one. Huge antitrust concerns from the start.
Yeah. Exactly. This deal was immediately flagged by regulators and consumer groups as potentially reducing competition significantly in the U.S. wireless market, going from 4 major players down to 3.
That must have created a very wide spread initially, reflecting that high uncertainty of approval.
It absolutely did. The initial spread was quite wide because of the significant antitrust risk and the subsequent litigation brought by several state attorneys general trying to block it even after the DOJ gave conditional approval. The arbitrage play here required a really deep dive into the specifics of the wireless market, the potential remedies regulators might demand, like forcing the combined company to divest assets, spectrum, or even help set up a new competitor, which they did with Dish Network,
Right.
and assessing the political and legal likelihood of the deal ultimately being permitted to close. It was definitely a higher risk trade, likely rated much lower on that alpha rank scale we discussed, maybe BB or even lower at times. But precisely because the market priced in such a high probability of failure for long periods, the potential annualized yield, if it eventually closed, was very attractive.
So patience was key there.
Immense patience. Those ARBs who did the intensive work developed conviction that the regulatory hurdles would eventually be cleared or sufficiently mitigated, and had the stomach for a multi-year process involving court battles, were ultimately rewarded when the deal finally received final approval and closed.
So it illustrates that even deals with major, obvious risks right up front can still be attractive opportunities if your detailed analysis suggests the market is overstating the probability of failure relative to the potential reward.
Precisely. It's not about avoiding risk entirely. That's impossible. It's about accurately assessing it, quantifying it, and finding situations where you believe the market price doesn't fully reflect the true probability of success based on your own deep dive analysis. It really boils down to probabilistic thinking applied to specific corporate events. Maybe one last quick example, the Disney acquisition of most of 21st Century Fox. That was initially announced in late 2017 for about $52 billion in stock, but it ultimately concluded in mid-2019 for a much higher price, around $71 billion, after a fierce bidding war erupted with Comcast.
The interloper risk we discussed earlier actually playing out. Comcast jumped in.
Exactly. This presented a really dynamic situation for arbitrageurs. The initial Disney stock offer created a certain spread. Arbs bought Fox shares. Then Comcast suddenly emerged with a competing higher all-cash bid. That immediately widened the spread against Disney's original stock offer and significantly increased the chance of either a bump from Disney or the deal going entirely to Comcast at a higher price.
So the arbitrage play transformed midstream.
It did. The opportunity evolved. It became less about just the initial spread and more about betting on who would ultimately win the bidding war. Disney eventually prevailed by increasing their offer significantly, switching partly to cash. Arbs trading it had to constantly reassess not just the likelihood of the original Disney deal closing, but the probability and potential value of a higher offer emerging from either Disney or Comcast, and the complex antitrust approval path for either potential buyer, as both were massive media consolidations.
Fascinating how that interloper possibility completely transforms the arbitrage play from a relatively simple spread capture scenario to a much more complex assessment of a bidding contest and multiple potential regulatory paths. Very dynamic.
It adds layers of complexity, absolutely. But the core principle remains the same. Analyze the deal terms, understand the players and their motivations, assess the risks, quantify the probabilities, and try to capture value as the situation resolves itself over time.
Okay, based on these examples and really the collective wisdom from all our sources, what are the overarching tips or best practices for someone looking to understand what really makes a successful merger arbitrager tick? What are the keys?
Well, several key practices are consistently highlighted across the different sources. First and foremost, maybe unsurprisingly, is conduct thorough, exhaustive due diligence. This means diving deep not just into the deal documents, but into the financials and public filings of both the target and the acquirer companies. You need to understand their underlying businesses, their strengths, their weaknesses, and identify any potential issues beyond just the deal structure itself. It also involves scrutinizing all aspects of the deal environment, the specific regulatory landscape, potential shareholder opposition, any tricky third-party conditions.
Don't just skim the summary prospectus. Dig deep.
Absolutely. Second, deeply understand all the deal terms. The price, the structure, cash stock mix, the expected timing, all the specific regulatory approvals needed in every single relevant jurisdiction, the exact terms of the break fees, and every single condition precedent to closing outlined in that merger agreement. Knowing exactly what needs to happen for the deal to close is absolutely fundamental. No shortcuts. Third, monitor deal progress continuously and actively. As we said, this isn't a set-it-and-forget-it strategy. You need to be constantly tracking regulatory filings and decisions, court cases if there's litigation involved, shareholder vote timelines and outcomes, all relevant news related to the companies or their industries, and any updates on financing status. You have to be prepared to adjust your position or even exit entirely if the perceived probability of success changes significantly based on new information.
Constant vigilance seems to be the price of capturing the spread.
It really is. Fourth, manage risk through disciplined position sizing. We touched on this, but it's crucial. No single deal, regardless of how promising it looks on paper, should be allowed to become so large relative to your total capital that its unexpected failure could cause catastrophic portfolio-level loss. Riskier deals get smaller allocations. This ties back directly to that live to fight another day philosophy, survival first. Fifth, diversify your portfolio. Spread your risk across multiple deals simultaneously. Ideally, these deals should be in different industries, involve different transaction structures, cash versus stock, maybe different geographies, to avoid over-concentration risk in any single area that might be susceptible to a specific type of regulatory shock or economic downturn. Sixth, be acutely aware of all potential risks, not just the most obvious ones like antitrust. While regulatory and financing risks are often primary, you also need to consider less common risks, like unforeseen litigation popping up, unexpected issues with satisfying specific closing conditions, or even, in some cases, potential cultural integration challenges down the road, though the ARB's focus is typically just on getting to the closing date, not post-merger success. You need to have thought about a plan for how you would react if any of these potential risks were to actually materialize.
So identifying all the potential failure points is only half the battle. You need to have a reaction strategy in mind, too.
Exactly. What's your plan B? Seventh, if possible, try to time your trade entry strategically. Now, timing the market in general is usually ill-advised, we know that, but in arbitrage, timing relates more to capturing the spread efficiently. Ideally, you want to buy the target when its price offers a spread that meets your yield requirements given the risk, and in stock deals, potentially short the acquirer when its price allows you to lock in the most favorable exchange value implied by the deal terms. Sometimes significant news events, periods of high market volatility, or initial market overreactions can present slightly better entry points if you're patient. Eighth, maintain a disciplined approach overall with clear entry and exit criteria established beforehand. Know at what point, based on the spread narrowing significantly or widening unexpectedly, or based on critical new information changing the probability assessment, you would consider adding to, reducing, or exiting the position entirely. Stick rigorously to your risk management framework. Maybe use portfolio-level hedges if appropriate in certain market conditions, though the primary hedge is often the paired stock trade itself in stock deals. Ninth, leverage synergy analysis. Now wait, you're not primarily betting on whether the combined company will actually successfully realize all the announced synergies, right? Your bet is on the deal closing.
Right. Understanding the potential for value creation from combining the businesses, the cost savings, the revenue growth opportunities, increased market power, etc., is still important. Why? Because it speaks directly to the acquirer's strategic motivation and how hard they might be willing to fight to get the deal done if significant hurdles arise. Understanding the strategic rationale reinforces your conviction in the buyer's commitment, even while you simultaneously acknowledge the common risk that synergies are often overestimated or that cultural clashes can hinder integration later on. So, the perceived strategic value gives the buyer a strong reason to push through obstacles, increasing your confidence they'll close.
Precisely. Finally, and this is perhaps one of the hardest aspects for many people, stay patient. Merger arbitrage deals take time to close, as we saw. The spread might fluctuate daily, even hourly, based on market sentiment or minor news items, but the ultimate profit or loss is realized only when the deal officially closes or definitively breaks. Focusing on the long-term probability and the timeline outlined in the deal documents, rather than getting whipsawed by short-term market noise, is absolutely essential. Remember, some complex deals can easily take a year or even longer to resolve.
Deep analysis, meticulous monitoring, rigorous risk controls, disciplined execution, and immense patience. It really sounds like a demanding full-time pursuit, which probably explains why it's primarily the domain of professional, institutional investors.
It certainly is at the institutional level, requiring significant resources and expertise. Now, interestingly, looking at the current market environment for M&A and therefore for merger arbitrage, one of our sources, Alliance Bernstein, offers a view suggesting a notable shift might be underway right now, potentially quite positive for the strategy going forward.
Oh, really? What are they seeing that indicates a positive shift? What's changing?
Well, they believe that some significant headwinds that have hampered M&A activity over the, say, past year or two, specifically things like rising interest rates, broader market price volatility, and particularly increased global regulatory scrutiny appear to be receding somewhat. As a result, they're seeing market sentiment towards deal-making becoming noticeably brighter.
So the overall environment is becoming more conducive, more friendly to companies actually doing deals again.
That's their assessment, yes. They view this change as a very welcome development for merger arbitrageurs because, fundamentally, the strategy benefits from a robust pipeline of newly announced transactions. They suggest this improving environment could lead to a significant ramp-up in deal volume, potentially driving what they call a new, longer wave of activity in M&A.
A return to more active deal-making, perhaps?
Yeah.
Like we saw a few years ago.
They actually draw a direct parallel to the dynamic seen back in 2021. That was a very strong year for M&A activity globally, partly fueled by very low interest rates at the time. And consequently, 2021 was also a positive year for merger arbitrage performance. They cite the HFRI merger index returning about 10.6% that year. While activity definitely slowed down after that peak, they now see several encouraging signs pointing towards a potential resurgence.
What specific signs are they pointing to as encouraging? What's driving this optimism?
Well, they note, for example, that the leadership at key antitrust enforcement agencies in both the U.S. and the U.K. have recently made statements or taken actions that might signal a potential shift towards a somewhat lighter, maybe more business-friendly approach to reviewing mergers, contrasting with what many perceived as a more burdensome interventionist period just prior.
Less regulatory friction could certainly help grease the wheels for more deals to get done.
That's the potential impact, exactly. They also point to anecdotal evidence, like business leaders increasingly discussing M&A possibilities and potential buyouts on their recent earnings conference calls, indicating a renewed appetite for deal-making at the corporate C-suite level.
So companies are talking about it more.
Right. And broader economic conditions seem to be providing some support as well, with generally rising equity markets providing valuation support and currency for stock deals, and interest rates that have largely stabilized or even shown signs of declining from their recent peaks, which helps with financing. Furthermore, they're seeing increases in some leading indicators of overall M&A health,
Such as?
such as a pickup in IPO and spin-off activity, which often precedes M&A waves, and even an increase in unsolicited or hostile takeover attempts, which can often signal increased corporate confidence and a willingness to pursue strategic goals more aggressively.
So, improved sentiment from regulators, renewed interest from corporate leadership, and more favorable economic conditions, all potentially pointing towards more deals happening.
That's the optimistic read presented in the source, yes. And interestingly, they note this positive shift in sentiment has already started to influence the market for existing deals, leading to a noticeable narrowing of spreads in some ongoing transactions. Deals that were previously trading at very wide spreads due to high perceived risk of regulatory denial are now trading tighter.
Meaning the market is pricing in a higher chance of closing.
Exactly, reflecting a higher market-implied probability of closing. And estimated timelines for completion for some deals are starting to shorten as well as confidence grows.
So the market is already starting to anticipate and price in the higher probability of success for some of these deals.
Precisely. Now, of course, even with this generally positive outlook presented by AllianceBernstein, they caution there are still significant risks to monitor. An unexpected increase in market volatility, especially if it's sudden and sharp, could quickly dampen corporate confidence and make financing harder to obtain again. Another unforeseen spike in interest rates could make debt financing for buyouts much more expensive or even unavailable. And, as always, increased global trade tensions, particularly between major economic powers like the U.S. and China, could easily lead foreign investment regulators in various countries to become more restrictive or even outright block cross-border deals on national security grounds, impacting global M&A flows.
Right, geopolitical risk remains a constant background factor you can't ignore.
It certainly does. However, their outlook suggests that if interest rates do continue their general trend towards lower levels, leverage buyouts, LBOs, are particularly poised for an increase. This is supported by the still significant amount of undeployed capital, or dry powder, held by private equity firms globally, and the continued prevalence and accessibility of private credit options as an alternative financing source outside traditional banks.
So overall, the current outlook for merger arbitrage, according to this particular analysis anyway, seems cautiously optimistic, driven by potentially more favorable regulatory and economic climates ahead.
That is the conclusion drawn from the source. A potentially more business-friendly regulatory posture, combined with sunnier sentiment in the corporate and financial world, could signal a sustained period of increased M&A activity, which, in turn, would create a more fertile ground for merger arbitrage opportunities.
Okay, so to try and bring it all together then, what's the core takeaway from this entire deep dive into the world of merger arbitrage?
It seems it's fundamentally a highly disciplined, intensely research-intensive investment strategy designed to capture relatively small, hopefully predictable returns by betting on the probability of an announced M&A deal actually closing, based on analyzing that spread between the current market price and the final offer price. Exactly. It's really not about predicting future fundamental performance of a company over years or trying to time the overall stock market. It's about conducting exhaustive due diligence on specific, finite corporate events, the announced deals. It requires deep analysis of complex legal documents, meticulous assessment of regulatory hurdles and financing risks, sophisticated quantitative evaluation of potential yield and closing probability, and just rigorous risk management at both the individual deal level and the overall portfolio level.
And the core philosophy, echoing the words of some of those investing giants like Buffett, Paulson, Munger, seems fundamentally centered on risk management first. The primary goal being avoiding significant losses, surviving to participate in the next opportunity, rather than chasing speculative, high-return long shots.
Absolutely. It demands constant monitoring, disciplined execution, especially for those tricky stock deals requiring shorting and borrow management and real patience to see deals through to their conclusion, which, as we've seen, can take considerable time. It's truly event-driven investing that requires a very unique skill set and temperament.
Which brings us, I suppose, to a final provocative thought for you, the listener. to consider after exploring this world of detailed analysis, probability assessment, and risk control. In an investment landscape often dominated by talk of, disruptive technologies, complex macroeconomic forecasts, and trying to predict the next big market moves. Could a strategy like merger arbitrage, one that zeroes in so intensely on the finite details of announced corporate transactions, meticulously analyzing probabilities and risks just to capture relatively narrow spreads, could that actually offer a more reliable or perhaps more consistent path to compounding capital over the long term?
Or, on the other hand, does its inherent complexity, its deep reliance on the sometimes unpredictable actions of regulators and third parties, and that ever-present risk of a deal unexpectedly failing, does that make it ultimately too challenging and perhaps too unpredictable for all but the most highly resourced, specialized, and sophisticated institutional investors?
Something to definitely mull over next time you see a major merger headline flash across your screen.